episode 4, we decoded inflation, the silent wealth killer. In Signal episode 5, we unpacked GDP, India's growth pulse. And this week, we go one step further to the real engine of stock markets, corporate earnings. Because in the long term, markets don't follow headlines, they follow earnings. Earning flows from learning. With Ganesha's blessings and teachers' guidance, may we keep learning, earning and growing in life, wealth and wisdom. Ganpati Bappa Moreya. And gratitude to all the teachers in my life. The list is quite extensive, so I'll sum it up by saying, Namo Guru. Welcome back to Signal, where noisy markets meet simple, sharp and sound insights for long-term investors. For the week ending 5th September 2025, markets had quiet range-bound week with gains in autos and banks offset by weakness in IT and consumer stocks. Sensex closed at 80,710 points, up by about 900 points from last week's close. Nifty ended at 24,724 points, holding just about the 24,700 mark. Autos and financials led on GST optimism, while IT and consumer names dragged. Mid and small caps posted modest gains. Foreign investors chose to remain cautious with light outflows, while domestic mutual funds continued steady buying. The rupee stabilized at 88 rupees per US dollar after RBI's intervention. How? The central bank sold a portion of its reserve, creating more supply and supporting the rupee. It's just like electricity board releasing extra power during peak hours to maintain the balance. Overall, a week that stayed muted, with global cues and profit taking capping the upside. And it's in times like this, investors are reminded to focus back on corporate earnings. Currently, sectors like autos, financials, ports, cement, metal, hospitality, consumer goods, capital goods, and agro-pesticides are all in healthy momentum. Markets dance to many tunes: RBI movements, oil prices, global headlines. But if you zoom out, one rhythm that dominates is corporate earnings growth. And here is the real question: why should earnings matter to you as an investor? Because in the long run, earnings are the foundation of stock prices. When companies grow their earnings, their stock prices usually follow. But if earnings shrink, then even the most popular companies eventually fall. Whether you invest in stocks directly or through mutual funds, your wealth growth is ultimately dependent on how much India Inc. earns. What should an investor look inside the earnings? What should revenue, margins, EPS, and future guidance? Is the revenue or demand rising? Because if revenues are rising, that means companies are producing more, which means that consumers are paying for the products and services being offered, and there is further room for expansion. For example, more families buying cars and two-wheelers, families spending more money on groceries, users paying for applications, subscriptions. These are all examples of revenue growth. But if revenues are declining, that means growth is declining, and that's your first instance of red flag. Revenue can easily be spotted in the quarterly results or news headlines. The next question is the business efficient? Margins tell you this. A healthy margin means the company can convert sales into real profits, whereas a falling margin means the costs are eating into earnings, and this can hurt the valuation of the company. One of the most common examples of increase in margin would be a local vendor increasing the price without increasing the quantity of sale. Margins are usually found in quarterly results or in news headlines. The third question is, are you benefiting as an investor? And that's where EPS or earnings per share comes in. Rising EPS means profit is flowing into each share that you own. A consistently rising EPS is where your wealth compounds. Say for instance, the company bakes profit cake and EPS is the slice you get. As cake gets bigger and bigger, your slice in it also gets bigger. EPS is also reported in quarterly results and can easily be found in news headlines. And what's next? Numbers tell you what happened in the past, whereas guidance show you the future roadmap. A positive guidance signals confidence and growth plan. A weak or unclear guidance, that's where disappointment begins. For instance, a bank announcing opening of 100 new branches or telecom company announcing a rollout of 5G nationwide plan. These are the positive guidance. Guidance is usually found in the management commentary of results or press releases. If you are a mutual fund investor, here is the good news. You don't have to do this line by line because your fund manager is already doing the heavy lifting of analysis of revenues, growth, guidance, EPS of dozens of companies. An outperforming fund would usually have more companies with higher earnings growth. Strong earnings means strong revenue, strong demand, more jobs, more profits, and ultimately a strongly growing portfolio. Markets may dance to short-term tunes, but in the end, it's this rhythm of earnings that dictates your long-term wealth creation. If you come from the day when banking was just an avenue to manage cash, then you'll correlate with this story. I come from a generation that saw my mum, Madhu, most comfortable with savings in cash, carefully placing it under the piles of clothes in the cupboard or tijori. And here is the funny part. Each time she gave me money, she'd say she borrowed this from one of her friends and I must return it when I grow up. But in reality, this was her hard-earned accumulated savings. Looking back, I feel what a champion saver she was and continues to be. But banks weren't popular back then. It all started changing in late 1990s with the arrival of ATM and debit cards. Suddenly, withdrawing cash was not a day's affair. It was just a machine away. For us, it was fancy, but for banks, it was an era of expansion and a key driver of earnings growth. But as more and more people started using ATM cards, debit cards and credit cards, it meant more fees and service charges for the bank. That's revenue growth. More usage, more profit. As these services scaled, the banks could spread costs across more customers while earning interest on credit cards and personal loans. Now that's improved margins. More profitability from the same business. With higher revenues and stronger margins, profits rose. And when this profit was divided across shares, EPS grew. This translated into shareholders benefiting from their investment. And management did not stop there. They talked about opening new branches, launching new apps, rolling out mobile banking. And this guidance provided more confidence in the future growth. From the time of my mom's cupboard cash to today's state-of-art digital banking, transformation has been commendable. And this transformation has created decades of earnings for banks, its shareholders, and mutual funds. And the lessons for us investors: the companies that grow revenues, expand margins, deliver consistent returns, and provide confident guidance about future are true wealth creators. That brings us to quote of the week. Benjamin Graham once said, "In the short run, market is a voting machine. In the long run, it is a weighing machine." And what does this imply? This implies that in the short term, stock market moves on popularity, news, emotions, hype. That's the voting. But over the long term, the market weighs real substance, revenues, profits, earnings growth, and only companies with real weight, real substance, real earnings power keep compounding and creating wealth for its investors. That brings us to the wrap-up of Signal Episode 6. We are building a strong community of engaged, enlightened and empowered long-term investors. If you're one of them, why not like and subscribe us and tell us in comments which company or sector you've seen where earnings growth have translated into strong returns.